So we are now in the pre-recording spot section of the show here. John is, I've already got my guest on, so we're way ahead of schedule here. It will only take me a moment or two to get everything live. Just bear with me for a second here. We're going to be live on my, right now we're in the pre-recorded part, and I'm live on the broadcast end, but it's not yet live on my website, which is what we really want to get happening here, because that's where the audience is waiting for us. I'm about 10 seconds away from having that done, so just give us a few moments here, and we will get done with the we'll get started with the regular show. All right, so if I'm on my website, and the viewers are on my website, it is live. All they need to do is hit play. So I'm going to get started now. Hello, everybody. I'm Allan Labucan. I'm the founder of the Allan Reports and the host of this show. Got one of my great guests here, John Kaiser of the Kaiser Research Online. Been having him on a bunch of shows lately, and John, you've really been on fire with your picks and your commentary on the market and the scene and the junior mining scene. So I'm great to have you on again, John. Thanks for coming on.
Allan, thanks for setting this up and bringing me on again.
Okay, well, I'll quickly go through my sponsors. I've got a new one, John, so keep your ears open for my sponsors. My sponsors for the website and all the work that I do for that matter include Wolfden Resources. Wolfden is looking for high-grade copper and nickel in Manitoba, right by Snow Lake. Their symbol's WLF. They trade on the Venture Exchange. Premier Gold is another sponsor of mine. Premier has a wide and high-quality pipeline of projects from exploration through to production with great partners, including Barrick, Centerra, and Goldcorp. Their symbol's PG on the Venture Exchange, or on the Toronto Exchange. And then my a new sponsor, or my other sponsor is West Red Lake Gold Mines. RLG is their symbol. They're chasing a high-grade target in Red Lake, Ontario, with Goldcorp as their partner. That's called the Hinge Zone they're drilling for there, and their symbol's RLG. They trade on the Canadian Securities Exchange. And my new sponsor, you'll know this name, John. Sirius Resources is now a sponsor of mine. They have a great project out in Quebec. John, that has been one of John's picks on past shows. I watched them go from exploration target. John had done a wonderful job of laying out the exploration theory for us. Then they drilled on that theory, hit hole 52, that got me excited, and why I started coverage in my reports and invited them on as a sponsor. So SOI is their symbol. They're on the Venture Exchange. John, I noticed you sparked your interest when I talked about Sirius there.
Yeah, no, I'm pleased to see you get one of the exciting new juniors with a play that could turn into a frenzy type play in Quebec later this year. And I just talked to Dominique, wondering where are your assays, and he said, well, they'll have a batch out in a couple of weeks, and another in the final batch out by mid-June, and they figure they'll be drilling again in early July. That's a little later than I thought they were, but they've had some logistics issues and so on, getting that all coordinated. But I think once they're rolling in July, we'll be hopefully getting a feed of news from about mid-August onwards, right through till Christmas.
Yeah, I had a chance to talk to Dominic at the Metals Investor Forum in Vancouver here this past weekend, or last weekend, and it seems like they're getting a pretty good handle on their targets there, John. I'm seeing that they've got a couple, the intersection of a couple structures there that they have a lot of blue sky in, and So what's your, have you had an update on how the exploration model is evolving now that they did those holes, since we sort of covered it prior to that drilling?
Well, they have not received all the assays, and they're still in the process of compiling it. And I'm not sure that I'm reading from their body language that they have that eureka, here is how it all hangs together. So I'm waiting with bated breath to see what not just the results as they come out, but how do they spin them? What sort of sections do they provide for us? What ideas do they give us? Where do they want to drill? Where do they think they need to chase these zones? I don't know any of that yet. They're not sharing that with us, so I've got my fingers crossed. I am hopeful, though, that in that, what he calls the Wildcat area to the northwest, they only have a few holes in there, and they reported some visible gold. So, the worst is we'll get some, 0.03 or 0.3, 0.4 grams of gold over 20, 30 meters or something like that, which I regard as small. But this is an area where they have got nothing, no information yet. And so if they start drilling in this area, and this area is up ice from the best part of the geochemical, the soil geochemical anomaly that the glacier dragged down ice from it. So I'm optimistic that when they start getting serious in this area, it will marginalize the southeast area where they have had the best results to date.
Well, that's saying something if you think that this could marginalize, because that southeast is where they hit the big hole 52, correct?
Yes, but it is still only a single intersection whose geometry is not yet understood. So this thing they need more a greater density of drilling to see how do the zones hang together. There are some systems where all you have is these erratic local high-grade zones, which if you turn them into a mining plan, you end up having to mine all sort of low-grade waste. You end up with a considerably lower mining grade than you end up with than you see in the nice intersection. This has been always a complaint about that Windfall project, where in the urban Berry township, which produces fantastic little intersections, but nobody can ever put a resource model, a domain model together, showing how it all hangs together and how you would actually mine it.
But you got to be kind of pretty optimistic about a 20-meter intersection of a hit like that, John? Unless they drilled right down something. It's sort of sitting out there on its own and needs some follow-up drilling around it, right?
Yeah, well, this is Brent Cook's objection to this. He says, okay, I don't yet see the zones connecting. I need to see more information, more geology, more zonation data, so that I can see what is going on here. And that's, of course, why this thing is still relatively cheap in the grand scheme of things. Virginia gold kind of looked like that a bit in the beginning too with Eleanor, and there was all this confusing talk about dikes and intrusives and things like that, and they weren't quite sure where the zones went to. But in not too short a time, they did figure it out, and the stock performed really well and got taken out at 750 million within sort of 18 months of first stumbling onto it. This little junior has spent 3 years trying to sort this out on a relatively smaller budget without quite understanding what is going on there. So, and I think whatever it is that's there is deeper than at Eleanor. At Eleanor, it starts at surface and then sort of dips down and goes deep. And they just had to follow the high-grade zone at surface, just follow it, and then follow it down plunge and outline the system. Here, they're still trying to find what is the trend to this mineralization.
Now that you sparked my interest there, John, when you talked about the wildcat, what they refer to as the wildcat holes, and I had a chance when I was talking to Dominique, and he is also very excited about those holes. And one of the things that he made me aware of was the direction of the drill holes. That they probably, if they knew what they knew now, they would have turned them around the other way and shot it in the other direction, and they may have just clipped onto something. That was sort of what I was piecing together from what I was hearing when I talked to Dominic.
Yeah, that was sort of the, I guess one might call in hindsight, with hindsight, the error of their original strategy. They figured the controls would be the margin between the Chichu intrusive and the country rocks, which runs northwest southeast. So you drill that perpendicular to that. So they drilled all the holes in a southwest direction, and then they would get the big smoke. You know, who cares? 0.3, 100 meters of 0.3 grams. Great if gold goes to 2,000. Not if it's at 1,100. But they would get these little teaser high grade snippets, and they would sort of drill another one. They wouldn't get it again. And now their thinking is there are structures, northeast southwest structures, basically perpendicular to the contact margin, which is a control, but it is not the localizing control. So this season they turned a drill around and drilled northwest, and that's the key thing that we're going to be waiting to see as they put all those results into their 3D model. Will zones start to take shape, because now they're drilling perpendicular to the actual zone as opposed to drilling subparallel or just sort of snaking past it and smearing a bit of it. So hopefully something like this comes out, and then they can just say, okay, now we go deeper and just drill it on 50-meter centers and start bringing an ore body into view.
Well, I think what they did learn from that last report that they put out, John, was that they, when Brent had some questions, I think they took that to heart and are going to be very careful about how they report this next batch of holes to make sure that they get the full story out there. I don't think they have anything to hide, and they want to make sure that they, get everything out there properly. So I was very encouraged by that conversation as well.
And there's another view emerging that this Chichu intrusive body does not have vertical roots. It's more like a slab, and that it's been a bit of a red herring. It served as a kind of cap to the mineralizing system. Now the surrounding paranise that's a pretty lousy host rock for gold mineralization, and when they drill into it, the gold quickly disappears. But they've been picking up this other type of metasediment, greywacke and so on, which is a major host up in the Eleanor. And even the reason they got so excited about that biotite schist was that's also a host rock at Eleanor. And the suspicion is that they may have to go deeper to find the real sponges that soaked up the gold. And it's not going to be this Chichu, this tonalite rock. It's going to be a metasediment of which they've only seen fractions. At Eleanor, the greywacke metasediment was what hosted the gold right away. So they sort of knew what they were supposed to be chasing and where it went. So it's still a mystery, but I think when this program gets going, we give them like a month to start drilling some serious holes to help them get the geology a little deeper than just 300 meters. And then in August, that's when I'm going to be paying close attention to the results that come out, because by then I want to hear that they've got a handle on the geometry of this system and are chasing it.
Well, John, I really am thankful that I was able to pick your brain again today here now as on a sponsor of mine, because you've been so helpful with us to get an understanding of this. Now, another one you talked about, and I want to talk about your Arizona in a while, John, but CVV is another one that we kind of broke on this show, because it was the day they announced, you were on the day they announced, or a day after they announced their diamonds targets. Since we last spoke, they've now done a deal with De Beers on the diamond projects in Saskatchewan. And what's your read on things now, John, with this De Beers stuff? The way I'm looking at it, they did 400-meter line spacing. They're going to have to go in there and do a lot tighter line spacing on their geophysics, and they've got a long distance between their where the known diamond indicator minerals are and their targets. So I would imagine they need to do a lot of sampling as well for to upgrade those diamond targets. With a partner like that, they definitely will have the money. So what's your read on that play now, John, and their uranium stuff, of course?
Well, when I first saw the deal, I said, you know, why did you do this? You gave away 90% of the project for not that much exploration expenditure, and you have you know, De Beers has 3 years to go to 70% and spend only 3.4 million. But then, you know, as I got into the details that Peter Dassler didn't really include into the in the news release, it became apparent, oh, well, the worst that can happen is it goes to 70-30, and then they can choose to participate at 30%, which is a pretty meaningful interest for a junior to have. Now, what was really interesting was the first-year commitment was $1.4 million, which, you know, in the grand scheme of things, when you look at diamond exploration, that's not a very big money. But when you consider what can be done in that setting for this stage of a project, that's actually quite a bit of money. Because Alaska, and I bet, and I think one day they will regret that they did this, they only stake postage stamp size claims on top of these mag targets that were visible at the 400-meter spacing airborne survey that the government did. And so this is fairly simple. De Beers is not going to do too much sampling. They're going to go in there with their helicopter and set down on these things. They're going to look and see what's sticking out of the ground.
And just drill.
It could be kimberlite, such as there was in the Buffalo Hills when Ashton had that play, or even Peregrine with Chidliak. So they're
going to just drill those?
An island, and they're getting ready to collect samples and all this, and they say, oh, okay, well, we need to pick up this big piece of rock and just process it, not fill bags with dirt and stuff like that. So I think if De Beers sees nothing, it will go down ice and fill the traditional sort of sample bags from the right medium. But then the goal is to fly a smaller scale survey, probably 100-meter spacing, and then see what happens to the targets then. And maybe they'll get back some samples in the meantime. But I think the strategy based on 1.4 million is targets that start to show up as proper targets. They'll go and do a ground survey on it, and they'll probably have a scout drill and poke a 50 to 100-meter hill into the target to see what it's made of. Is it some strange granite or whatever? Is it a lamprophire, or is it kimberlite? And I think they'll bang all the really good targets by April of next year, and that's where the 1.4 million. So this is particularly exciting for future.
Because that was my thinking, John, is I'm calculating things and I'm going 1.4 really isn't going to, if I'm doing the exploration, it isn't going to get me quite to drill ready stage to be confident with my targets. When I got 75 to filter through.
Yeah, but at the end of the day, the question is it a kimberlite, and what is its chemistry, and what is the microdiamond content of it? Yeah. And you need a drill hole for that, or stock kimberlite sticking out of the ground, and you just grab the piece, and you don't have to mobilize a drill rig at all until later when you want to delineate it. So it's a long shot play. We really do not know whether or not these are kimberlites. We do not.
Well, you just made a good point there, John, because I'm thinking of it if I was running an exploration play for a junior, what I would do, it's a little different when you're De Beers and you're not dependent on, you know, being accurate with your drilling because the market is watching you so closely.
Yeah, well, I mean, Peter's company is a uranium exploration company, and while they have some technical expertise in diamonds, they do not have the deep knowledge that De Beers has. So they've made a gamble and said, okay, we will give this to De Beers on terms where they have to kind of hit it hard so that we'll know. And again, De Beers gets to go to 70% no matter what. So another $2 million exploration, you'll end up getting a lot more information. So within 2 years, they'll know if this is what kind of size kimberlites these are and whether or not they have decent diamond content. They won't have mini bulk sample grades, so they won't have a sense a strong sense
Oh
for
man, I just want to know if those are kimberlites at this stage. If those are kimberlites, it's game on. We'll figure the rest out later.
What was funny was on that day, all that area got map staked by all the armchair speculators as soon as De Beers endorsed the area by doing this deal. But what was interesting, one of our zombie search and rescue targets, Fiordland Explorations Inc.
Yeah.
Dick Atkinson had staked buffer zones around Canalaska's things, going on assumption, well, these kimberlites come in clusters, and there's usually one big one that shows up at that large 400-meter scale, but then there's lots of other little ones. So they staked those buffer zones. But after that,
he's got some experience in diamonds, doesn't he?
Oh yeah, no, they've done diamonds. I mean, Major General started it off in Greenland, and it became Diamonds North, and so on. So there's overlap there with the diamond stuff. But they got the idea that at that conference in Vancouver, the Metals Forum, where Canalaska presented,
I was there.
They could just tell by Peter's body language and his sort of refusal to want to spend his own money. And with the season getting close to, being time to do something, they just sort of guessed he must be very close to a deal. So they went and map staked everything around that area. So they infilled the whole oval, within which, of course, De Beers and Canalaska has an area of interest. So the next thing for De Beers is they're going to have to do a deal with Fiordland, except Fiordland doesn't have to spend any money for the next 12 months. Because if De Beers can't find anything there, well, there probably isn't anything on the buffer claims surrounding it. So they're sitting pretty there with they got $200,000 negative working capital, 100 million shares out. They've crawled from 2 cents to 6 cents, and the 5-cent warrant holders are now suddenly waking up and saying, "Okay, DA, we're going to help you out," and exercising it. So pretty soon it'll be neutral, and then somebody will give them some money. And maybe he can even that he's got 15% interest in that South Boise's Bay concept, which he tried to earn a majority interest in last year, but just hit the wall with the severe bear market. So if he can revitalize that, get a new option deal on that, so that, or even if the partner commander decides to run with it, they at least have a 15% interest in you end up with a dual track story, one where you don't really have to pay anything now. So what I think will happen is they'll probably approach De Beers and say, you're going to have to fly this on spacing that includes our ground, and we're willing to chip in and pay for that, and we can sort of share all this information. So they'll probably do some deal like that.
And De Beers kind of gets a bad rep sometimes. I know because I worked with them before, and I would think that they'll do something like that with us. They paid for a processing a 500-ton sample with no strings attached. So, this makes sense. If they might tie in some sort of option or first right of refusal. John, I did see something at that Metals Investor Forum that I had a really important technical question that I was curious about. It was regarding the geophysics themselves, and I thought that when I first looked at it, that it looked like these were like booming mag high targets. And I sat down with Peter at that conference, and he went over the geophysics with me, and the area is pretty quiet, and these are just little mag highs, but they're not like boomers because of what's going on around it, right? And so I think that they could be those subtle type mag targets that, because you don't want those booming mag targets. It's usually the subtle ones that are of more interest for a kimberlite, right?
But we'll keep in mind that magnetics is a relative thing, and there's probably not a lot of magnetite and other magnetic materials in that sandstone that blankets that basin. Therefore, like in that area, 2,000 to 3,000 meters above the basement unconformity. So if some magma comes up with a lot of olivines and other sort of like the nickel mineral and all these other things that are magnetic that come up in there, that will definitely create a discontinuity.
But what I'm saying is, John, in that quiet horizon there, yeah, these things do pop up as a mag target, right? But it's not like it's a booming mag target where it's full of ilmenites and stuff like that, where you got to get a little more worried. It is a relatively, subtle type anomaly, even though it sticks out of that sandstone so easily.
Yeah, yeah. So I mean, a lot of, I mean, there's like magnetic lows too, which is simply based on the reverse polarity of the Earth, and of course, it's the difference. So these will be holes rather than sort of things sticking out type of thing. But again, it's the relative change. It's a disruption with this quiet background, and that's what has everybody intrigued, because there aren't too many explanations for these types of disruptions against such a quiet background.
Oh yeah, and he had a model of the depth of the crater at that where they are, right? And they look to be in a pretty good spot there in the keel.
Yeah, well, but again, what's the history of this portion of the Ray Craton? Did it undergo a thermal event which destroyed all the diamonds? I mean, look at like your little favorite junior Dunedin in the East Arctic, Nunavut. All those kimberlites that they found were all after 220 million years ago. And then the dikes that they found that had diamond content were 230 million years or earlier. And so clearly there was a thermal event which came through there and wiped out the diamond stability field. And, subsequent kimberlite eruptions picked up nothing. And so they're all barren. And so you never know. Again, this is why to change the topic, I'm just right now working on peregrine diamonds, which of course has the Chiliad project, which is undervalued and all that for reasons that I cannot understand, because Friedland company is supposed to be overvalued, not undervalued. But they've got this Sequani project that they just announced. It's in the southeastern part of Botswana, and they talk about kimberlite that De Beers had found, I don't know, a number of decades ago. They used a percussion drill on that, and apparently it is diamondiferous, but there's no information about the quantity of the diamond
They were finding any diamonds if they were using a percussion drill.
And the chemistry indicates high to or moderate to high grade diamond potential. But apparently why De Beers abandoned this stuff was they got all these little sketchy intersections of kimberlite that didn't seem to hang together. So they may have thought they were dealing with some sort of dike field, and nobody wants to bother with dike fields in Botswana where you have Orapas and Shuanengs and so on to chase after. So the Peregrine guys, with their ex-De Beers guys, tracked this down. It came available. They applied for it and are now going in there with drilling the geophysics and with core holes so that they can understand the relationship between the kimberlite and the country rock, and see if in fact what they're dealing with are the aprons of kimberlite, proper pipes and so on, where the center of them is not well understood because of the whatever peculiar geophysics of that area. So here we have a play where we already know it has diamonds. It is got prospective chemistry, but we don't know if there's meaningful volume there, and the market, of course, doesn't give a damn about it. So that kind of thing could turn into a screamer of a discovery with just
I got another question for you. I got another question for you on Peregrine, John, and I am very excited about Botswana because in the diamond world, if you want to talk about elephant country, literally in diamonds, Botswana is the place. So any diamond success there is going to catch everybody's attention. But on the stuff up in Baffin, they're close to coming out with some important economic studies. John, what's your feeling on the OPEX and the CAPEX costs for what they've got up there? I'm trying to get in my mind a picture of what grade and valuation they're going to need to cover. How much are they going to need, and what kind of grades are they going to need in order to pass the hurdle on the CAPEX and be able to make money on the operation?
Okay, well, I've already done that outcome visualization for that, which people can find on my website. If they're subscribers, they can see the detailed assumptions. If not, they can see the conclusions of that. And they've published resources now for both CH6 and CH7 down to the open pittable limit. And together it worked out to about, what do we have here? The whole system
Going
could
down
take,
to 300 meters.
yeah, they didn't even go that far, 240 with one, and I think 260 meters with the other. But the tonnage that they came up with combined is only 9.6 million tons at an average grade of 162 carats per 100 tons. And if you average out the value of those things, that's from the bulk samples that they've done, you end up with what do we get here? $186 per carat. So
that roughly works out to about what are we looking at in raw rock value there on a per ton basis?
On an average,
you're looking at about $250 rock. 180.
No, even better than that. For the CH6, it works out to over $500 rock, and it's about 150 or so, 180 for the because for the CH7 pipe. And obviously CH6 is going to be mined first in CH7.
And so that'll run the big economics of building the whole thing, and CH7 will be a add-on. So it's only got to pass the hurdle of OPEX.
Yeah, so I went and looked at the Sabina Back River project for which they've done a feasibility study, an updated smaller scale feasibility study, and the scale they have is very similar. So I've imagined here a 3,000 ton per day open pit mine that with the amount of ore they have there is going to run about 10 years. And to build that would cost say $400 million Canadian, and give them a sustaining capital of 100 million, and then mine the stuff at $4 a ton with a strip rate. What do I have here? I have some sort of large 6 or 7 to 1 strip rate, and processing costs $50 a ton, G&A 15. So it works out to about 93 Canadian dollars a ton to operate this open pit mine. And you run that at discounted cash flow model using, say, 9%, what I came up with. And that comes in with at a Canadian dollar outcome, $700 million after-tax NPV. So that's what, theoretically, this would be worth. And others are starting to do it. And the PEA that the company is going to deliver, hopefully by the end of June, is going to tell us the actual numbers that the engineers and that have come up with, who are doing the.
So they're going to do all the details that you didn't have a chance to do.
And I guess the market's not very eager to. I mean, right now it's priced below what I would say fair value. Absolute fair value for this type of outcome. The stock should be 40, 60 cents in that area if these numbers turn out to be reality. So if
John, they suffer a little bit from the don't piss off your shareholder problem. We saw that with Barrick, right? And I even today, I was just talking to someone today that's looking at taking some options. They want to go long on a big gold producer, and they said they were going to do it on Barrick. And I said, isn't there a better choice? I'm still have them in the shit list for all the shorting that they did and how brutal they made it on gold in the 90s. I'm still giving them heck for that. So, I think there's something to that, be careful about pissing off your shareholders.
Yeah, but Rick Rule absolutely adored Barrick for taking gold, helping take gold down to 260 so that he could super bottom fish all these companies from the 93 to 97 period that got bombed by the post sort of Bre-X massacre and then the gold massacre. No, you would think that Rick paid Barrick to go and do this sort of stuff, gave him the idea. Here, go do this. take gold out. You probably told the Brits too, like, hey, you need to publicize selling 100 tons or whatever every few months so that everybody can front run you and hammer out the gold ahead of your sale and then cover their short.
He wouldn't do that, John. So yeah,
Oh, he's a clever guy. You never know how far-reaching his machinations go.
But John, even if your numbers are really, really conservative, are really, really optimistic here at 93, and let's even give it $150, that's still making money on CH7 and a ton on CH6.
Yeah, but if my capex numbers and that are correct, and then you boost the opex that high, your NPV starts going down. Because sort of a rule of thumb is that you don't want the capex to be higher than the NPV using a reasonable discount rate. And by the way, the 5% that all these gold companies use, that's total BS. That the real world does not use 5% as a discount rate for a gold project.
What's the proper one, John? 9, 10?
8, 10. I see 8 to 10% for safe jurisdictions. If you want to be in the DRC or somewhere like that, then you want to get up to 15% or 20% even, and 20% is quite brutal on your NPV.
But that's a risk number you're looking at too there, eh, John? The more the risk, the more I get it.
Yeah,
So,
I mean, it's the same thing as an annuity. How much money would you want to pay now to get a certain, a fixed series of cash flows over, say, a 10-year term deposit?
We can't have much confidence in those projections, right? That's how.
Well, and that's the thing. If you're lending the money to some little rinky-dink business, you're going to want a very high return on that, as opposed to if you're lending it to a government, backed entity such as a bank or whatever. I guess that's doing it backwards.
Why the hell are they using 5%? That's like no risk money.
Exactly. That's why I complain. Well, they say, well, but the real interest rate is negative and all that.
Yeah, but you ain't getting the real interest rate.
Where they're using negative interest rates as their discount rate. So I kind of wonder how that works. I got to try that. Plug that into the Excel spreadsheet and see what happens.
So, John, that's been a couple that you've been talking about. And by the way, I think that people should start to pay a little more attention to Fiordland. I don't know. I can't say today that I think it's going to be a good zombie pick of yours, John, but you've already started to talk about it, so I'm already putting it on your list of one of your zombies that could come back to life. That's an interesting one for CVV. Another one that's been catching a lot of attention lately, John, is that NXE. It's caught my attention for a couple of reasons. One was the option deal that they did. I don't think that was very friendly to the shareholders. And again, you might sense that I got this thing about pissing off shareholders. But that option deal of 20% rolling has kind of concerned me. It sort of said to me that a company that already has, a few 100 million shares out isn't that concerned about the shares issued. But the bigger thing is right when they did that, it started to roll over a really key technical indicator that I follow. And if it goes through there, I think that there could be potential for it to head towards a death cross kind of action. What's your read on the NXE story these days, John? I saw you put a little blurb out there earlier.
Well, on this issue of the 20%, that's just a theoretical right. The board still has to decide to actually grant options. It simply says they have the right to grant up to 20% of the issued shares that are out. And I don't think they have, that many options out. But yes, this is what happens when companies feel they have a major success on their hand, and they've had to dilute extraordinarily through Bay Street financing. So they did 50-cent finance, and they're up over almost 400 million shares or something like that, fully diluted. So the people who are the original founders and the management and that, they end up with pitiful stakes because they just get diluted out. And so the cost of generating wealth they get marginalized. They don't get much of a reward. And being able to set options, even though it's like they may set them at $2, if 20% of 400 million, that's like 50, 60 million shares allocated amongst management, and then say it gets taken out at $4. That's a substantial score for all the people. So what you really have to look at is how they handle the allocation of these options. Are they giving it to the guys who already own a huge pile of paper already and just being greedy at the expense of minority shareholders, or are they truly rewarding the people whose efforts have enriched all the shareholders by actually delivering a success?
Well, now that brings up the second topic, which was you put out comments earlier in the CEO chat about the high grade core, and I'm starting to, now that I'm seeing the stock try to maybe get a little technically bearish, I'm wondering if there's been a lot of arm waving with that project, John, and it seems to me like they're maybe looking at the whole zone as being the high grade zone, and that's what's got this, thing having an $800-900 million market value. What do you have you looked at this zone, and what does it look like? How's this thing holding together, the big high grade zone?
Well, I haven't looked at it in sufficient detail to see what the distribution of the high grade is. They are dealing with basement hosted zones, so there'll be near vertical structures, very similar to the triple R of PLS, and they're stuck sort of drilling it from surface, so they're never really getting true widths because it's down at 600 meters or something like that. So statistically, the resource estimate probably doesn't have the greatest reliability. But what was interesting was that they completely collapsed the tonnage by moving the cutoff grade from 0.25%, which gave them, I think, 2.5 or 3% uranium, and 200 million pounds, and they raised it to 10%, which is nice MacArthur River type high grade ore, and they ended up with 200,000 tons of 20%, which is pretty good. If they can double that, we've got something pretty good. MacArthur River itself was 1.8 million tons of about 15% uranium. But the important thing now is the cost of producing this stuff. MacArthur River is at the unconformity, so right where the sandstone meets the basement rock, and the mineralization is both in the basement and in the sandstone and in the structurally messed up area, which is of course critical for the formation of this. So they have like obscene $7,000 a ton processing. Half of that is underground mining. They have to freeze all the sandstone to keep the water from flooding it, problem they had at Cigar Lake. And then they're dealing with super hot rock, so it's all, remote mined, and they have to deal with it in the mill, the Key Lake mill, and so that costs them $3,000 to process this. And so you're talking $6,000-7,000 a ton OPEX for something that's $9,000-10,000 a ton at that $28.50. And when I crunched the numbers, I fell off my chair. MacArthur River is worthless at $28.50 spot uranium. It is the best uranium.
Well, that's why they had to put a 10% cutoff on it, because anything lower, it doesn't make sense at anything lower than that.
Yeah, and the sort of the perverse thing is that you get these extremely rich grade in exactly that type of environment in the Athabasca Basin, where you have the meteoric water, sort of the rainwater stuff, mixing with sort of magmatic waters coming up from the basement cracks, and the mixing that they do right in this area where there's all this graphite there, a nice chemically receptive sponge to drop the uranium out and soak it up, that creates these very rich deposits. In the case of NextGen's Arrow, what we need to learn is what is the competence of the rock, what is the continuity of the ore there, what grade ore are you going to handle? Are you going to have water problems, or is your cost only going to be, say, $3,000 a ton, or like they thought with Hathor, which was also basement, the Rough Rider zone was basement hosted, but it was only like 300-400 meters deep, not 600-800 meters deep. and they were using $1,000 a ton. Fission in its PLS PEA uses a much lower $350 per ton OPEX, because they're basically open pit mining this stuff, and then it's considerably lower grade. So the dynamics of the cost of a uranium mine, you know, that's a lot of guesswork. And right now the market may starting to be thinking, okay, PEA is the next stage for next gen, and is that PEA going to shock us with some numbers that are not good with the grades that they have? That's why I took a shot at this idea of, you know, oh, we have 200 million pounds of uranium in the ground, and therefore that should get whatever, 10 bucks a pound valuation. This is total BS and applies to gold and everywhere. This per pound in the ground valuation metric does not normalize for different grade, different recovery, different mining contexts, and all this kind of stuff. A pound in the ground is not the same as the pound in the ground next door.
Absolutely, and people need to pay attention to that in a big way, John. And just because you have a pound doesn't mean you can mine that pound. And you just said earlier, one of the best deposits in the world doesn't make it at 28.50. It makes it because of the real forward, the contract price of uranium. So yeah, it's interesting. You just made me want to do a little bit of homework, more homework on FCU too, John. It's been pummeled pretty good since they fell through with that potential takeover by, or merge, or whatever they were calling it, with Denison. Yeah, you got to look at these things differently, eh, John? That's the problem with the street. Oftentimes, it's like it's a binary, right? It's either this is better than that or not. And it doesn't work like that. You got to look at these things more in depth and try to break down those numbers, because, you know, at $350 or $400 costs, that might be more valuable than $7,000 rock down deeper.
Yeah, no, you have to evaluate things in that unique mining context and recovery characteristics. To make a comparison with our series that we were talking about earlier, when Dominique initially looked at that, he thought he had some 5 million ounce low grade, easy bulk mineable system on his hand, because the grade was coming in at 0.3 grams per ton. Well, at $2,000 an ounce, those ounces are worth something, but at $1,100 an ounce, they were below the economic cutoff grade. So this is where, like, you know, one of the things I always ask people when they talk about, yeah, gold's going to $3,000 or whatever, I ask them, okay, why? Oh, the debt's going to explode, and they're going to print enormous amounts of money, and that will lead to massive inflation. And so then I ask, yes, and of course the equipment needed to mine that gold is going to stay at the pre-debasement hyperinflation and all that. So please help me understand, you know, how this project, as this
we still won't make any
grams per ton is worthless at $1,100, is going to be worth anything at $3,000. And you know, the biggest dummies in the hyperinflation fiat currency debasement camp are those who buy gold to protect their purchasing power. Well, you know, if you were such a smarty pants and bought a lot of gold in 1980 at $400, well, inflation adjusted, that's $1,200, and you pat yourself on the back and say, I'm real clever. I have not lost the purchasing power of my money. But Uncle Sam comes along and says, but you have a capital gain, which we tax at 35%, and where I live in California, oh yeah, and we add our 10% on top of that. So all of a sudden, I've lost 43% of my preserved purchasing power. I've actually lost. I'm no better off. There is no really safe way to avoid this type of
it's always binary with so many people, John. It's either the world is ending and you got to own gold, or you know, everything's great and you got to own stocks. Everything's nuanced in this world.
Well, that is the underlying assumption. They come back at me and say, Well, in this scenario where we have hyperinflation and all that, the government's going to collapse, the tax regime is going to collapse. Nobody's going to be collecting any capital gains tax for me because we will have civil chaos and everything, and I'm going to be there with my lead supply here and my gold supply here and an instrument to deliver the lead to you when you come to take my gold, and and that's the future that you should prepare for. And I say, okay. I don't think I'm going to devote the rest of my life preparing for that sort of future.
I think I'll go with the rest, actually. If that happens, I'll let this. We're getting to a point now, John, where it's time we've got to start talking a little bit about our zombies. You got me thinking about zombies there. If the world goes to an end there, we got the zombie apocalypse. We have our own zombies in the mining business, and you and I have been having good chats lately after our shows, and we want to get this search and rescue going. I had to ask you, John, what are we going to consider a zombie for the picks? Like, what is it? Just that they are undercapitalized, or like, what do you think is a fair? We're going to do a shows down next show. We're going to start bringing more zombie ideas. We're calling it the search and rescue. So I guess we got to make some parameters of what exactly are we calling a zombie, John. And you've done so much research on it. I think you kind of can handle that better than me.
Well, in my search engine, the parameters I set is like from $200,000 working capital to maximum negative $1 million working capital. So that's the first filter.
So they're either on fumes or they're underwater.
Yes.
Okay.
And then I look for ones which, where management owns less than 10, insiders own less than 10% of the stock. So that type of company is one where it'll have jingle mail, where the insiders may just hand the keys to Mr. John McCoach and say, "Here, you take care of this mess."
Hey, if you know any of those, John,
torches and pitchforks.
If you know any of those, I'm actually looking for one. By the way, I want to literally save a zombie. But anyway, so they got to have management with a position.
Well, no, actually, we want the position not to be very visible because these are the living dead companies. So these are companies where there's no real apparent future. And this is what people like Tony Simon has sort of, tarnished all companies that look like this, as the stock exchange should delist them. They're a blight on the system and all that. And so what I've said, well, yes, but not all of them are like that. Some of them are real companies with real management teams, with projects that can, that still have potential, exploration potential, and so on. And so what I want to go through, this is like what I used to call extreme bottom fishing. In December, it was easy. It was the opposite bar. They had to have more than $200,000 in the treasury, and that shrunk the field hideously. And then I looked for people that I knew just from memory that these were not incompetent crooks.
You mean you knocked it down to 20 picks, John?
Well, I came up with 100, and they're up 100% or so, better than the 400 companies that make up the TSX Venture Index, only half of which are resource sector. But what I'm thinking is this: we think we're in a big sort of a bull market. I listened to comments on the CEO.ca and so on. This bull market turnaround is still in its infancy and can get snuffed out. And you can see that in that most of the zombie companies are still cheap. A lot of the zombies will be turned into future IUD bombs to explode the public. All that debt's going to be converted into very cheap free papers. The insiders are going to own it all, and they're going to go to Rick Rule's prospect generator companies and borrow some property from them, farm into it, and of course, because it comes from the hallowed Sprott Global complex of back prospect generators, it's got to be a good project, and they'll beat the drums and they'll lure in retail when this bull market's more advanced, and then they'll blow all that cheap paper in there while they pretend to do an exploration program on that project. Those ones I wish would just go away and disappear. Those are the ones zombies I would like to come up with, a zombie killer function, and my OVS system is going to do that sort of thing. It's going to make it clear that there's no story here, is just a liar on top of a hole, like Mark Twain described it. But it's the ones which are still the real ones struggling, that the circumstances have drowned. These are the ones that I want to look for, because you can buy them 2 cents, 3 cents, 6 cents. They're like barely alive. And this is why that Fjordland exploration is such a classic example of a fake zombie company.
I think the rules should be, John, because some of that's nuances of what, you know, a good stock picker would do. Some of the stuff you're talking about, insider ownership and stuff. I think the litmus should be, are they on fumes? So they have less than 500 grand. Okay, what does it cost these? Okay, 200 grand. They've got, that means that they've just got enough to keep the lights on and pay the exchange and all your listing, and basically live on hot air. That from $200,000 and down, if they got less than that, I think that those are candidates. They may not make the grade, and I might not want to pick them, but you know, I think that that's a good sort of barometer, or you know, mark that we have to pass, don't you, John?
Yeah, something like that. But what I'm sort of proposing that we do is we pick a letter of the alphabet, and we kind of just we set these search parameters just like any member of KRO can do. And then we walk through these things and we kind of look at them, click on this thing, and sort of, and of course I will cheat because I get to say which letter it is, and so I'll have spent more time than we together will do, so I'll kind of already know which ones are real stinkers. And the real stinkers I won't talk about, because I don't want those guys coming after me with machetes and stuff like that for you know, giving them the big thumbs down on air. But what I'm thinking is we go through there and look at these and basically just demonstrate on this online thing, how do you think about these things? How should an ordinary investor approach stuff like that? What sort of questions do we ask for? And
well, you've gone even one step further than just thinking about it, John. You've put together models that we can actually just say, I call you up and say, hey, John, let's look through the A's, just total random. We can start going and doing our research, and that in-depth screening of, say, I don't want any zombies with copper projects, or I don't want any zombies with zinc, or I don't want any uranium zombie. I just want a good gold zombie. I can start looking at putting all that criteria down with the tools that you've given, and I can save myself hours and hours and hours of research by just the filters that you've done. So, you know, I've told you before, and I'll say it again, and I'll say it to anybody that's listening. You have to go and check out John's tools on his website and for his subscribers. If you're serious about doing this, investing in junior mining stocks, and I understand that this model could be used in other sectors as well, but just understanding John's visualization models and rational speculation and how he breaks things down. It will, even if you never listen to a single pick of John's, which I'm not suggesting would be smart, but if you just ignored every pick, just that filtering tool alone will make you money. It'll make you a better investor. And so I love the idea, John, of using your tools as the filtering for us to do our zombie search and rescue.
Now, an important thing that you allude to is I'm actually just, I'm renting time. I'm selling time, because, you know, even convincing yourself that this is not a zombie, that this is actually a, you know, a diamond in the rough, takes a lot of time and effort. What you do not want, and this has always been the curse in bottom fishing and so on, which is why I ended up digitizing everything, creating this into a big database company, is you want to be able to get rid of the duds as efficiently and quickly as possible, because so you get 90% of the companies gone in 10% of the time, and only 10% of that remaining 10% are going to be the winners that you're looking for, but that's going to gobble up your time.
You know, when I started thinking about that, John, and why that's so important to me, is because when I was on BNN a lot back in around 2007 to 2012ish, they would call me up out of the blue and I had to get out there and have ideas like now. And I didn't have time to waste to look around. I had to be able to filter things quickly and get right to a good pick and something I can talk about right away and be downtown to talk about that within a couple hours in front of, how many people on camera. Now, our investors don't have to do that, but their time is just as important as me being able to try to get into Vancouver to do that show. And that's where I think that you can that tool of being able to filter is just so valuable to me. If I had this, John, it would have saved me tons of time when I was on TV back then a lot.
Yeah, and the search engine I have it's got so many facets. It's even got sort of technical analysis indicators in there, very basic ones. And the idea that I'm trying to push to my readers is forget about listening to me. Just learn to construct a search model where you go there every day and search this, click on these couple of searches that you've bookmarked, and it'll be some hideously long string that gets bookmarked, and then just walk through. And because of the way I present it with the chart and the link to the latest news release and all that, it's very quickly for you to spot, finally there's a hit in my super duper search that I'm not sharing with anybody. And then you said, I wonder how long it's going to take Kaiser to find this company. I better load up on it now before he and Barry somehow blunder into the seas and trip across this company and blab it to everybody out there. And then the next day it all cranks up. Well, I'm going to be long that thing before that happens.
Well, you've given people the tools to do that, John. It's just I can't stress enough to people that you got to check those tools out because they give you so much power at your fingertips. It's remarkable to me every time I look at it, John, what you've done there, as far as putting the filtering tools together. And I believe I said it to you privately, John, and I believe this strongly. When it comes to the big cap stocks that I follow in the US, the key indicators that the main filters that I look at are price to earnings ratios and earnings growth. And I try to use that as my fundamental barometer and then look at what's going on with the technical pattern in the stock trading. What John is doing, the trends, those important trends, let's say call them such as Bollinger Bands, things like that. Those are the tools that stand the test of time because they're so important, they're so useful, and they do what they're supposed to do. John's created those same kind of tools for the mining sector. Now, where you have to look at where's the property, what commodity they're in, a whole bunch more variables than just, let's say, the price to earnings and the growth in earnings. Now you've got all these variables, and where is this company along their life cycle? Are they a junior looking for something, or have they found something and they're way over here? Well, you can't. John is enabling you to say that this tiny little exploration company over here is actually less risky than this giant over here that's mining based on these parameters. Your tools, John, are going to last the long haul.
Well, no, they won't, because the reason they're valuable now is because this sector, this space, is still very inefficient in terms of coverage. Those earnings ratios on that you follow with the real companies, so do thousands, tens of thousands of other people with the same algorithms, the same methods, and some of them spot them faster than you do. And anything that you find that meets any metric, it's already properly priced. So all you ever get is the random walk of the market, which is why all these hedge funds are just getting—
Oh, John, there's always—
they're underperforming the indices. And so people are saying, what are you guys doing that's useful? And some of the wiser ones have sort of said, we are our own worst enemy. We basically cannibalize each other's algorithms and things like that, and we wipe out whatever edge that we had. It only works in the very beginning when you're the first. And in this junior resource space, it has no audience. Hardly anybody has data at their fingertips the way I do. And so nobody's really doing this. And coming at the end of a horrific bear market where there isn't yet really enough capital flowing in to keep it alive, you can find these opportunities that have 3-5 bagger potential just to normalize, because it's like some little bedraggled kitten that managed to plop into a puddle and you think it's dead, and then you grab it out and dry it off and all that. And next thing you know, you got this purring kitten there growing into a nice tabby cat.
Well, John, I appreciate your modesty, but first, there's a couple things I would add to your counter there. It took a long time before people understood price to earnings ratios and earnings growth and PEG ratios and actually interpret those successfully. And I would maybe argue that it's still not there. What you're doing is so in the infancy stage, and we're so far behind that to get to that market penetration, we're 10 to 20 years away from that happening, John. It's going to take a long time before everybody's sitting down at Kaiser Research and looking at your speculation models and starting to do rational analysis of where these companies are in their life cycle and what should a reasonable valuation be.
It's gonna be less than 2 years, because the reason I was late for this session was I was on a phone call with my Australian venture capital partners on the outcome visualization system we're building to what I do with my stuff just within this system here. This is going to be made available to the crowd to do anonymously or just with a handle and share in a public space with anybody able to see it. And that's going to completely change the evaluation dynamics of this sector.
So is that what you're saying, John? It's a couple years until it's completely automated where anybody can just run into your website and do it?
Well, it won't be my website. It'll be separate from my stuff. It'll render me obsolete. So, but then I'm going to become one of those sharks swimming in there. Like the disclaimer is going to say, everybody here is untrusted, has no credentials. Their sole goal is to manipulate their fellow players in the system and the market, and anything that they do or say has a conflict of interest. They're either short if they're going to crap on a project, or long if they're going to pump it. And if the things change and all that, they're going to sell their position first and then go out there and change their mind and all that. This is going to be the disclaimer, and this is going to be the operating assumption of everybody. But your ability to develop influence depends on you actually being a reliable player in there. So you go in there like a dirt bag and just shill everybody and all that. The system tracks everything. Your peers vote on you and sort of give you the thumbs down and so on.
So this is an actual environment or platform where we can go and
yes.
chat and
imagine like you're a gladiator going into the Colosseum. The Colosseum is the frame. It's all the people watching, and you're going in there and you're going to visualize what this Hermosa Taylor thing is going to look like, and then you're going to share it there, and then your enemy's going to come up and say, well, you're totally wrong about this, and put some little tiny piece of outcome visualization there, and then it's going to screw off. And meanwhile, the market's out there doing its thing, and all of a sudden it's going to swing towards your valuation. So you're the genius and the poo-pooer is the bad guy, but that tables may turn on another thing.
So will there be a gaming element to it too, John?
Totally. There'll be the players the people who actually go in there and do all the homework and assemble all the numbers, the kind of thing that I do now and charge people for doing. They're going to do this, and their payoff will be their reputation starts to build, and so they're able to exploit their conflict of interest more effectively, whereas I'm stuck not making any money because I'm honest and so on. I just have to rely on subscription fees coming in. And then there's going to be the guardians, the ones that don't share very much, but are all these former engineers and geologists, or even present ones, who go in there and look for the bad guys and crap all over their stuff and say this.
that's very similar to what kind of goes on at CEO.ca, but without the the platform of being in the context of a rational speculation model and changing the variables around so that you can visualize a different outcome. And is this guy just being fanciful, or do you actually have something hard to go with?
Well, see, this is the thing, that the CEO.ca forum, it's still text driven and it's linear and so on. But you know, I made a comment when I was on there a few weeks ago. I said things like this are going to play a very big role in what I'm building, because what you're going to refer to is like, okay, Kaiser says Hermosa Taylor is worth you know, $1 billion if all his assumptions come true. And within my system, you may be able to, like, you know, judge the plausibility of the various assumptions and so on, but there's not going to be much that you're going to say. But in other forums like Stockhouse or CEO.ca, the people, the spectators, will refer to that and say, well, what about this JK guy, and what about this BC guy? This BC guy's got a, you know, completely different perspective. And then there'll be the discussion there, and this will then link into the Twitter world, the Facebook world, and all that. And there'll be, Stockhouse will be in on it, others will be in on it. They'll all be referring to this arena that I've built, where the players and the guardians do their stuff. And the regulators are going to loathe it. They're going to absolutely loathe it, because there's nothing they can do about it. It's not like it's pretending to be anything other than this, you know, collection of schemers and all this kind of stuff. But because of the competitive nature of it, and the way a reputation can only be positively built by doing the right thing, it will actually float the truth to the surface. And it'll end up predicting what a PEA or a resource estimate looks like before it comes out.
John, that is awesome. When is this all going to happen?
Well, the IT guys are working on it, and you know how IT works.
Yeah, well,
but I've done a lot of the coding and specifications myself. This is not a case where I've given them a dream and now the poor IT guys have to figure out how to convert Kaiser's dream.
You designed it for them, and
I actually created all the data models and the codes and the equations and everything and the rules and so on. So they're just being professionals, mapping it to a commercial environment. So this could go a lot quicker than I imagine.
I can't wait, John. Well, you know, I'll be in there. I'll be looking at those things because John, I'm already using it. Like, I've noticed you did one of those models for, which one was it? It was, anyways, it was, I've noticed two companies now that have really high quality projects, but they're on the low end of the S curve. And I actually think that I got some good room there where I'm okay in between the bottom of the S curve and the top of the S curve. That's was something I asked you about, John. Is there any way, like between 100 million and a billion, right? It's hard for me to differentiate between 345 billion or million. So whoever's, you'll know who I'm talking about.
It's a logarithmic scale, and we are actually discussing how to do that, and there's scaling functions. I mean, I can't do it in my thing. I have my little graphics and that were written for me some time ago.
But that's where it's going to get really interesting, John, when you can get down into that finite information, whichever curve you're in, whether you're just on your rational speculation curve, or now I think we're starting to get into the start of an S curve type action, or maybe tomorrow I think, hey, this has gone too far. Maybe
what you'll find is that in intraday trading, the market will end up using what the crowd is generating in the system to create a kind of like because I use ranges, I don't use perfect, you know, singular numbers, I use ranges. Right. So then there'll be sentiment swings, and there'll be these battles to push it down to the lower end and then push it back and try and figure out where it's going to inflect.
Yeah, because some guy could be saying
the short-term gamblers are going to come into this, and literally I'm creating a gambling framework for them. And then this will create enormous liquidity. And the companies, people who back the company with 10-cent stock will be able to feed stock into the 30-cent market that's become all liquid and put the proceeds back into the treasury. It'll be a way of enabling that old model, which is broken, where the core backers sell their cheap paper and then reinvest the proceeds, minus what they need for taxes, back into the company at the higher price to keep the story going. If these regulators do not get rid of this existing shareholder part of the exemption so that everybody can put money into treasuries, the trend towards eliminating all brokers, if we end up with just a system of dispersed accredited investors, the junior venture capital sector dies, gets starved of capital. So this system will make it possible for one of the older methods to fund companies by generating aftermarket liquidity that isn't like some newsletter hack being paid to pump something, and so all of a sudden there's a big burst of buying, which is hit with a bunch of selling. No, this thing will be dynamic. It'll be self-generating all the time.
And it'll be based on reality. It won't be just like, trying to sell some moose pasture against something that's real. You actually can look at these things and look at them and compare apples to apples.
Well, that's why the sort of pretend lifestyle companies, they won't have a chance in this world, because the audience will be focused on companies with management who's actually doing something. Like, is there a program underway? Or are you just sitting there putting out little presentations and not actually doing anything in the ground? And that means the capital allocation is going to be far more efficient. What the Tony Simons of the world complain about, that these zombies suck up the risk capital, divert them, that problem will disappear, because the risk capital will already know that's just a sinkhole. I'm not putting any money there, because it's not going to generate an audience of players out there visualizing the outcome, and another super audience of gamblers who are betting on the changing perceptions and also on what the truth machine is going to churn out. Because it's absolutely critical that either something like the commodity price is in flux, or that the company is changing the fundamentals of the company for better or worse through exploration work. And there's no other real space like this. It's kind of unique the way this junior sector is structured.
Well, John, one of my big beefs in this industry that I've been in since the early 90s, I think you've been in it even longer, since the 80s, I think, haven't you, John? Is that we are pretty horrible at asset allocation. Where we put the capital doesn't get distributed very efficiently. And what you're suggesting there and putting together is a tool that will cause better asset allocation. And I'm all for that, because I'm always trying to filter out junk, John. I try to focus on the quality, and sometimes the audience spends a little too much time focusing on junk for me, and I'd rather them focus more on quality, and your tool is kind of going to get us there.
And if this gets built and works the way I think, it will also end the stranglehold that certain complexes have on the system, where, for example, if you're not endorsed by a certain a brokerage firm or group or whatever, you just can't get anybody's attention. This system will become a truly merit-based system, where it is on the merit of what the company is presenting, how it's presenting, and so on, which will attract the audience. And it doesn't need the endorsement from the Carlsbad machine to be able to get all the capital, to get capital attracted to it. Because one of the things I've witnessed is there is this power structure in this world where some companies just get shunned if they don't play the game that's required for those who hold the keys to capital and market influence. And that power structure is under siege anyways, because of the way the brokerage firm is changing. But even if the brokerage industry evaporates and just becomes a discount brokerage type of a system, there are still these structures, these marketing structures, where entire networks of newsletter writers who all get shanghaied into the same sort of deals, which are all endorsed by a certain group, and you take something like a Frank Justra network. I mean, that has a whole network of backers behind it. That is a machine type of system, and yeah, sure, those can function in there, but the kind of almost monopolistic power they've had,
that's the problem. That's the problem. When it becomes monopolistic, and everybody has a right to go out there and do business. But John, I've never, as you could probably imagine, I've never been, that crowd has never been too fond of me. It's kind of why I went out on my own and did my own report. And John, you kind of fall into that category too, I think, a little.
Yeah, no, I'm not particularly popular, which is why some like orphan companies that I adopt somehow seem to not get taken seriously by these other the system, and other pieces of crap get absorbed and promoted and all, and I just scratch my head and say, well, they're clearly not using fundamentals as the basis for their decision making, and so
more about betting on the system than it is betting on the project and the company and what they're trying to build than it is. And that's never been something that I've been interested in. That's why I'm kind of a renegade, and you are too, John. And I guess that's why we like doing these shows together.
Yeah, no, it's just fun.
You bet. Well, on that note, I think we've given the audience a lot, John. Again, thanks a lot for coming on. Your shows are always real popular with my audience, and you've done such a phenomenal job of putting together a bunch of names there before action happened. I think you might be actually onto something with your new the potential zombie pick that could come alive there. And again, I'm a big supporter and promoter of the work that John does. So thanks again, John, for coming on.
Allan, thank you very much. It's been great.
Great. And on that note, before I close, I always have to stress that the show is for information purposes only. It's important for you to do your homework and speak with your financial advisors before making any investment decisions. I want to thank my sponsors for their support. They make this possible. For my guest, John Kaiser, and for all of you for tuning in. Have a great day, and we'll see you soon.